Welcome to our weekly market review. And this week, I'm joined by Andre Celia. He is the currency strategist at Treasury One. Andre, thank you very much for joining me. We will take a quick run through of the week that was for the markets and kind of what we're anticipating for the week to come. Now, this week, we're taking a special look at inflation. It is the metric of 2024. Everyone is following it because everyone is trying to pinpoint when that first rate cuts will start happening. And last week, the OECD came out and they released their inflation expectations and their forecasts. And from what I can see, Andre, the monetary policy lever is seemingly doing its job against and winning this fight against inflation finally.
Yes, good morning. If you look at inflation, it's been with us for quite some time. The higher interest rates by the US, by the rest of the world, has been with us for quite some time. Now, everybody always thinks that when you increase interest rates to curb this inflation, is that it will work through immediately. It's a long-term process. People dwell into their savings, and now there was an excess savings in the United States when they handed out checks after the COVID situation. But people don't immediately react to it. It takes a while to filter through the economy. And then as it filters through and people have less and less to spend, that's when the specials come out, if I can term it that way, from your retailers. That's when inflation starts coming down, is when demand starts dwindling down and the retailers come out and keep their price increases to a minimum. In a lot of cases, as I say, offering specials to attract those buyers back into the market. And so, yes, it's now starting to filter throughout the world, and no wonder that the OECD has then lowered their inflation forecasts for most countries, as we can see on this nice little piece of information that we have on the screens. So yes, it's filtering through and we are seeing a decline. This week, importantly, we're getting new figures, so let's see how that round looks.
Yeah, so US inflation figures for January is coming out on Tuesday, and everyone will follow it very closely. And we're expecting inflation to at least have moderated over this period. And it's an important data set because it will give or set the stage at least for the Fed's March meeting coming up. But, there might be disinflationary pressures coming through finally in the US, but March still might be too early to start cutting rates, right?
Yes, we must remember that the inflation rate for the US currently is above 3%. Now, it is expected that the next figure to be released tomorrow will be lower and to come in below the 3%. But that's still almost 1% or 1% away from the targeted rate of 2%. And the month-on-month figures coming out over the last couple of months has been consistently above 0.2 in the order of 0.3%. Now, take 0.2, multiply it by 12, and you still have 2.4. So that's still above the target rate. So you need month-on-month figures to really start slowing down tremendously so that you bring down that averages over the last 12 months. So it's a slow process, and the Federal Reserve and Mr. Powell specifically has more than once said they need to see inflation closer to the 2% with robust job growth, with very good economic growth in terms of GDP. They're not forced to immediately react or to react too soon. So his rhetoric in his speeches of data dependent and higher for longer is really holding water. So no, I think the second half of this year is the timing that we should be pasting into our diaries as where interest rates will start declining.
And it's not just Powell that's been that's taken this cautious stance. I mean, we've seen it from Christine Lagarde from the European Central Bank, and to a certain extent, the central bank in the UK. They've all taken this cautious stance, and with good reason, because there are just so many tremendous uncertainties within the market, and one of them is what's happening in the Red Sea, of course. With the Houthi rebels attacking vessels, they say it's Israeli-linked vessels. It's not necessarily always the case. And no one knows exactly how this is going to play out, because we've got a lot of experts saying, even if there is a ceasefire in Gaza, there's no guarantee that that will necessarily stop the rebel attacks in the Red Sea. But this is causing troubles for arguably the most important trade route in the world, because no one can go through the Red Sea. We see troubles in the Suez Canal, then of course going for Egypt as well, as they're seeing a loss of revenue, with big troubles on the horizon for LCC if that continues any longer. But from a global perspective, with these attacks on global inflation, it will likely have an impact. So when can we start seeing these effects coming through and filtering through the economy, if at all?
Okay, so I'm glad that you've put up that graph for us, because it's a very, very important graph. And if we look at the developments in the Middle East, there's almost an increase rather in activity than a decrease in activity. So that leads to elevated oil prices. We can see this graph clearly telling us less traffic through the Red Sea area, more around the Cape of Good Hope. And that increase in shipping cost, most specifically and importantly for the Northern Hemisphere, is not filtering through at the moment. This once again takes a month or 3 to filter through. So in your March and April figures, you might see this. This will keep the Federal Reserve and central banks throughout the world on the cautious side, rather waiting to see how this filters through, whether it's going to be a sustainable pressure on the inflation rate or whether it will be subsiding. And hence, once again, adding to that longer, the higher rate situation before there will be a decline. Because this is a great cause of concern. Elevated fuel prices and elevated cost of shipping is something that could cause a second round of inflation and a turnaround in inflation rates, which means if that is not stopping and carrying on, we're not only seeing a longer, higher interest rate, it also places pressure for a second round of interest rates on the existing interest rates. Take this whole situation in the Red Sea area and you link it back to the war. Remember that in the war situation, the US is actually benefiting in terms of economic growth from that, because they're sending aid to the countries there, and that aid is in the form of manufacturing of weapons and army stuff or weaponry in the United States. So this aids their jobs, this aids their economic growth. So this is a great cause of concern.
Yeah, it's not great news to hear that more interest rates can come on top of interest rates. But if any of the viewers is keen to find out more, ETN did a podcast on the economic impact on Africa stemming from the Red Sea conflict. It is available on our YouTube. Andre, before we wrap up, the RAND report, there doesn't seem to be much positive news during the rounds to support the local currency at this point.
No, the rand is always an interesting currency. We have elections this year. We have a budget coming up in 2 weeks' time. We've had a horrible political speech during our SONA. We've had stage 6 load shedding thereafter. So things are not going our way. However, I stick to my guns and say that the second half is where we see interest rates declining in the world. That is where I think we will see the dollar losing some of its color and the euro and the pound gaining traction against the dollar, and that will also benefit the rand. So for the moment, the rand trading in an 1860 to 1920 range, I'm quite happy with that, and I think that's very sustainable going forward.
Great. Andre, thank you very much for joining me. Have a good week. We'll catch up with you again next week.
Thank you.